Welcome back, everyone. Let's go ahead and talk about these two definitions, actual dollars and real dollars. And again, we're talking about the impact of inflation on economic analysis. So, actual dollars or cash money is what you can really feel in your pocket. The actual dollars in circulation. They're also called inflated dollars because they carry any inflation that has reduced their worth. So the money that you can think of or very tangible to you, those are actual dollars. But real dollars are also called inflation-free dollars, adjusted for the effect of inflation, always expressed in terms of some base year dollars. They say 2017 base dollars, right? And that means what was the actual worth of a dollar in that year, and that's what we're talking about. So the real dollar is always based on some reference year. It's either this year that we're in right now, or some previous years, or some future years. Now the question is, when we see in a problem says O&M costs are expected to be $30,000 annually for the equipment's 20 years life, does that mean the accounting records for the next 20 years will show constant costs of $30,000 or no? Well, the text tells us that it's going to be $30,000, but what it actually means is that it's going to be $30,000 in terms of today's worth of dollar. That's what it means, really, the meaning behind it. So to answer this question, if years pass by and after 20 years we look back at our accounting records over 20 years, we will see that the O&M costs actually increased every year because of the inflation. But it was the same $30,000 in terms of the 20 years ago worth of dollar, right? So the answer is obviously no. Instead, it means that in real dollars, the O&M costs are not expected to increase. So if we take out the impact of inflation from the dollar, the O&M costs are going to be $30,000. But in actual dollars, we'll pay more each year because of inflation. But each of those dollars will be worth less. So that's the idea here. All along throughout the past modules, when you see values, for example, for O&M cost over time, and you were given a single value for so many years, those were in terms of real dollars, not actual dollars. So now you may ask yourself, okay, why do we even bother? We can just use real dollars and real interest rate and avoid inflation in our calculations. And that's a valid statement. But there are specific items such as depreciation deductions where inflation impacts the cash flow in a more complex way. And that is the exact reason why we're incorporating inflation into our cash flow analysis, because of the impact that inflation has on depreciation deduction. So if we're not dealing with depreciation, essentially if you're only dealing with before tax cash flow, and we're not doing any depreciation or income taxes, then inflation doesn't matter in our calculations. But once we start calculating depreciations and after-tax cash flow, then inflation becomes more important. Something that I want to emphasize here, and it was in a couple of slides back here, is that use market interest rate when dealing with actual dollars and use real interest rate when dealing with real dollars. And this is very, very important. If you want to take away one important statement out of this video, is going to be that when you're dealing with actual dollars inflated dollar, use the market interest rate, and when you're dealing with real dollars, use the real interest rate. So if you mix this up, your calculation and your results will be incorrect. Now, before we look at one example here, let's take a look at a few notes here. Cash flows are stated in a variety of ways. The three most commons are actual dollars, today or times $0, which is a case of a real dollar because it has this time base attached to it, or year one dollars. So it's either actual dollar or real dollar. And real dollars are typically year 0 or year 1. If it's not stated in a problem, if a simple statement of constant values is all you're given, the normal assumption is that they are times $0. So that's going to be your assumption if they don't mention. So we're going to go ahead and take a look at one example in the next video.